The chairman of the House Financial Services Committee, Barney Frank, said on television this week that it's a pretty simple matter. Don't lend money beyond what they can expect to pay, and don't lend money without verifying what people can pay back. That's pretty good advice, isn't it? Why don't they follow it?
Sounds pretty simple, right? Well, why didn't they follow it? Because there was so much money to be made in fees by not following it. Throw money at people who can't pay their loan back. It won't matter. I'm not going to own the loan. I'm not going to have it. It'll be somebody else's problem by the time it comes a cropper.
So what's the effect down on Main Street? What is it, when you look out across the country, what does this mean to ordinary folks?
I think we're going to have a protracted decline in real estate prices. And whether or not, it depends what your circumstance is. Each person's different. Do they have equity in their home? Then they don't have to worry so much. If they don't have equity in their home and they have a mortgage that's going to reset at a higher rate because interest rates have risen, maybe they can't afford the mortgage anymore. Maybe their house is going to go on the market. It's going to be a long, unwinding process. It's not going to be pretty. It's going to have a negative or pressure effect on real estate. Continued. We've already seen it to some degree. And I just think that people are going to be less willing to take risk, and that will extend into the corporate bond market, the ability for companies to raise money. Their interest costs will go up. They'll have to pay investors more because investors are going to say, wait a minute, I'm afraid of risk here. I'm going to demand more money for my investment dollar. Companies will have to pay more. It's going to have a major impact.
Who's responsible for this fiasco?
Wall Street is responsible. Investors, to some degree, are responsible. They were clamoring for yield. They wanted more return on their investments. Regulators were asleep at the switch. Bond rating agencies were asleep at the switch. They're supposed to be out there telling people this is a solid company, or this is a solid loan, or this is not. There were a lot of fail-safes that failed.
Who's supposed to be minding the store?
Well, that's the problem. Again, we have a situation where there are regulatory loopholes or cracks in the system that allowed this kind of speculation to take place. First of all, in the old days, a banker had to, of course, respond to his regulator and had to have the proper implementation of rules and regulations. Now we have mortgage brokers that are not regulated by anyone. We have mortgage appraisers who might have an interest in jacking up an appraisal on a property to get a fee. They're not regulated by anybody. So we have these cracks in the regulatory net that have allowed this mania to really go on.
But where's the Fed in all this? I mean, I was in Washington a number of years. The Fed had an office of banking then. It was its job, its mission was to try to make sure that there was some due diligence and some oversight of this kind of process. What's happened to that?
Well, the Fed is interested in the safety and soundness of the financial system, okay? And so in this particular situation, you have loans that are being made, then securitized, made into securities sold on Wall Street. So the bank is not at risk necessarily as much as it was in the old days when a bank might make a bad loan. Now it's the investor who owns the loan. The Fed is not about protecting investors. That's the Securities and Exchange Commission's job. So it's changed the whole way that mortgages are now sold, underwritten by banks, and then the unwinding.
Was Washington feeding this, fueling this, or welcoming this? I mean, after all, it is a good thing when people can buy homes that they couldn't afford otherwise. So if you're a politician there and people are happy in your district because they're buying a house, you feel pretty good about that, right? You're not going to say no to the gravy train.
Absolutely, and it's been a policy of the government to try to encourage home ownership. And with this mania, with the subprime loans that were going on, we did reach a peak in home ownership of 69%.
Right, the highest in history.
The highest in history. But I would ask you, what's the good of getting people into a home if they can't afford it and they're then going to have to go into foreclosure? It goes back to the idea of suitability. Are these loans suitable to the people that you're giving them to? Are these investments suitable to the investors who are buying them? There seemed to have been a breakdown in that question.
Is there anything anybody can do? The government? More regulation? What?
I'm not really a fan of more regulation when the existing one didn't work. I think smart regulation is the answer here. I think what you alluded to earlier is a really important point. In the securities industry, in Wall Street, when you buy a stock, you are supposed to, your stockbroker is supposed to say, Bill, is that an appropriate stock for someone of your income, your age, your needs, what are you looking for? You're not supposed to buy a sketchy stock if you're a person who only wants safety. Why can't we have that same kind of an idea with a mortgage? Is this mortgage product appropriate for you? In the securities laws, it's called know your customer. It's called, is it appropriate for you? I think we need something like that in lending.
Doesn't the government have to ask it, doesn't
No.
it? Who does?
It's left up to the bank, to the lender, to the mortgage broker, and
Bear Stearns?
Yeah.
To the hedge funds?
Yes.
But I mean, look what they've been doing. Their past experience is no indication that they will respond to what you're saying.
Only if they're held accountable, and if they have to pay the bill that comes a cropper. Let's not make it a bailout where the taxpayer bails out Wall Street, please.
Then Wall Street would be the winner.
And Wall Street would say, fine, I'll go do that again. I'll go throw money at a problem and let it blow up, and I don't mind.
Does this contribute to what you and I both know is growing inequality in the country, the gap between the rich and the poor, the greatest gap since 1929? Is this contributing to that gap?
To the degree that Wall Street made an awful lot of money on these securities, yes, it contributes to that gap. To people who worked on Wall Street, you saw the enormous bonuses, the enormous payouts to the CEOs of these firms. Absolutely, the mortgage mania contributed to that. The little guy doesn't have the benefit of all the powerful friends in Washington and the powerful friends on Wall Street. The little guy is just trying to be able to retire comfortably and not have to scrimp and worry about money, and he and she have a right to that. And if we're in an ownership society that's ballyhooed around, that should be a benefit. That should be who wins. But unfortunately, the little guy is the guy that's usually the bag holder.
Are we living in a new Gilded Age?
Absolutely. A new Gilded Age, except this time around, instead of when we had Vanderbilts and Goulds and Morgans and pick your name, building
Rockefeller?
physical assets that produced goods that people bought or transported goods.
Steel firms,
Correct.
Right.
Now this Gilded Age is all about pushing paper around and making money on money.
Financial engineering.
Financial engineering, exactly.
Well, thank you very much, Gretchen Morgenson.
Anytime.